recording. Okay, so we are now in topic number 11, deck number 11. And we're talking this unit all about share exchanges. So non-Section 85 share for share exchanges, both with the same corporation and with other corporations. And the three types of share exchanges that we're going to focus on are sections 51, 86, and 85.1. So sections 51 and 86 are internal exchanges where shares of a corporation are exchanged for different shares of the same corporation. Section 85 is an external exchange, and it applies to share for share acquisitions of corporations by other corporations. Somebody's trying to find me. It's weird when people from within your organization, you can see that you're blocked off, phone you in the middle of the blocked off period, but whatever. All of these, so basically what all these provisions do is they permit a tax deferral on these share exchanges in the appropriate circumstances. And so again, the reason why we have these share exchange provisions is substantially similar to the reasons why we have deferral provisions like Section 85. So the first idea for allowing these types of deferred transactions is that as long as a person remains economically invested in the same property, then they haven't had a realization event that should give rise to any tax consequences. If a person is simply substituting shares of a corporation for different shares of a corporation, then their economic fortunes are still tied to the economic fortunes of the corporation to the same extent. So it is largely the same economic risks and rewards, even if the shares might be preferred shares versus common shares or some distinction like that. Our goal here is that we should only be taxing the exchanging shareholders at a time when they decrease their overall economic investment in the corporation, because at that point it's when their gains and losses have really become locked in. The second reason we do these share exchanges, and this might differ, it differs a bit and it doesn't from Section 85, is that it's less theoretical and more practical, right? That having to pay tax requires money. And so if you're just exchanging shares for other shares of the corporation, there's no potential for you to receive money on that exchange. And so if there was going to be a taxable event, then you would need liquidity from other sources in order to pay the tax. This could be a pretty academic concern, for example, if you had a situation where, let's say, there was a share for share exchange in a foreign corporation that was a portfolio investment for you, and none of these exchange provisions applied, and you had like $200 of tax payable, who cares, right? And most people can find most people who have non-deferred investments outside of a TFSA or an RRSP have $200 that they can use to pay the tax in that circumstance. But if this is a $20 million gain and you've got to stroke a check for, let's call it $2.5 million of tax, that's a very different story, right? So as a practical matter, we don't want to have tax on share exchanges until there's a cash out event. The nice thing about all of these provisions that we're going to talk about today is that they all apply automatically without the need to make elections. And in one case, which is a Section 51, which we're about to talk about, you don't even have to report anything at all when the exchange happens. So these are cheaper to implement than a Section 85 exchange, and there's less notice to the CRA that you're doing something, which can be relevant if you're doing something you think the CRA might not like in the bigger picture. So with that, we can flip to slide 3, and we can start talking about Section 51. And we can start with subsection 51.1, which is really the operative provision in Section 51. So subsection 51.1 is the basic internal share exchange provision, and it applies to the most straightforward share exchanges. Its conditions of application are set out in the preamble of subsection 51.1, paragraphs 51.1a and b, and subsection 51.4. And so they're listed on the slide, and to just run through them very quickly, the taxpayer has to receive a share of a corporation, fine, in exchange for another share of the corporation that was taxable property. So that was capital property. So it tells you that this has to be an internal exchange of shares held as capital property, or it can be on a bond or debenture of the corporation. Again, if it was capital property and the terms of the instrument grant the holder the right to convert, then that can be done on an internal basis as well, as though the bond were a share. You can't go from a share to a bond, but you can go from a bond to a share. No non-share consideration can be received. That's pretty clear whether that's complied with or not. And subsections 85.1 and 2 and section 86 don't apply to the exchange. So that tells you there that section 51 is the lowest provision in the hierarchy of share exchange provisions, that it only applies when the other ones that we are going to talk about or have talked about in the case of subsection 85.1, when they don't apply. So of all of this, the really important point to focus in on, because it's a little bit different, is that subsection 51.1 can apply to the conversion of a bond into shares. But the holder's right to make the conversion must be found in the bond or the terms of the bond in order for the exchange to qualify. And so the reason why we do this is that it makes sense for bonds with a conversion feature into shares to basically be treated as shares for the purposes of section 51, because these convertible bonds have the same upside as the common shares, and they get priced accordingly, right? There's no downside because they have the same downside risk as the bond, that if the common share price doesn't hit the exchange number that you've targeted, then you just never convert. But if they common shares do perform outside of expectations, then you would convert, and so again, that's built into the pricing because everybody understands that that's how convertible bonds are going to work. So that's fine. And so as a result, if you're doing that, then the bondholder's investment is really only changing in legal form as a result of the conversion. It's not changing in economic substance. So again, that's why we allow it. In either case, like we've gone through, and like it says on the slide, the share or the bond being exchanged has to be capital property. So a dealer in securities who would own shares or bonds as inventory cannot qualify for a Section 51 exchange. Not going to have to worry about that in this course. And again, given that shares and debts of private corporations are almost always capital property given irrigation industries, you probably never have to worry about this condition very much in the private company context at all. And then again, subsection 51.1 prohibits non-share consideration. And so you must have a straight share for share exchange. If there's even $1 of consideration, section 51 does not apply. And then again, finally, subsection 51.4 establishes that section 51 is the low man on the totem pole when it comes to share exchange provisions, that if anything else applies, section 51 does not apply. So those are the conditions. And if we flip to slide 4, we can look at the effects of subsection 51.1. And so there's a bunch of conditions after you get to paragraphs 51.1c and d. You get into a whole bunch of other things in paragraphs d.1 to f. For the purposes of this course, we don't care. And so we're just going to ignore paragraphs d.1 to f and pretend that they just don't exist. If they ever become relevant to you, it'll be in practice, and at that point you'll be well equipped to figure these things out without me. So just know that those paragraphs are there, and think about them some later time when someone's paying you to do it. So the first impact of subsection 51.1 applying is that paragraph 51(1)(c) deems the exchange to not be a disposition of the exchanged property, except for the purposes of certain provisions that, again, we don't care about in this course. So that's great, right? This is the only share exchange provision that does not result in a disposition. And so without a disposition, there is nothing to report, right? And that can be very handy, not only for, like I said, from the tax avoidance perspective, that if this is part of a bigger tax plan, the fewer things that are on your return, the better. But also just, for example, in the international tax context, for those of you who are taking international tax, there can be various circumstances where Section 51 could apply to a share-for-share exchange, where not having a disposition is actually a very good result for most of the things dealing with taxable Canadian property. For the most part, is what I had in mind. But for our purposes, the material point about no disposition is that there's no proceeds of disposition, so there's no possible gain or loss that could result, and there's nothing that has to be reported. The second impact of subsection 51(1) applying is that the ACB of the converted property, whether it's a bond or whether it's shares, becomes the ACB of the new shares issued on the exchange. If there's more than one class of shares issued on the exchange, then the ACB of the exchanged property is converted, is prorated across the new shares based on the relative fair market value of the new shares. So those are the effects of subsection 51(1). So again, very straightforward. And if we flip to slide 5, we have an anti-avoidance rule in subsection 51(2), which is materially similar to paragraph 85(1)(e)(2). And because, as I say, if you loved paragraph 85(1)(e)(2), you're going to love subsection 51(2) because it does the same thing. So if there has been a section 51 exchange and the property exchanged is worth more than the shares received, then subsection 51(2) can apply if it is reasonable. If it is reasonable to conclude that some portion of the shortfall is a benefit that the exchanging party wished to confer on a related person. So this portion of the shortfall is called the gift portion in subsection 51(2). If that is the case, that you have a gift portion, then paragraph 51(2)(d) provides for a disposition for proceeds of disposition equal to the ACB plus the gift portion or the fair market value of the convertible property, whichever is less. And so if this results in a capital loss, then the capital loss is deemed to be nil under paragraph 51(2)(e). The effect of paragraph 51(2)(f), which is also part of this equation, is that the ACB of the shares received on the exchange won't be increased unless the fair market value of the shares is less than their ACB. So if the shares were in a gain position, there was an accrued gain at the time that you did this internal exchange that resulted in a gift portion, then there will be double tax in the future because the related person is not somehow going to obtain the ACB on their shares, and paragraph 51(2)(f) is going to prevent any ACB addition for the exchanging party in this transaction. And so this is the major downside of getting trapped in subsection 51(2), just like it was a major downside of getting trapped in paragraph 85(1)(e)(2). And so, like paragraph 85(1)(e)(2), the way to get out of subsection 51(2) is to use a price adjustment clause in your transaction documents implementing the share exchange. Again, in order for that price adjustment clause to be effective, you have to make sure that you've actually made bona fide attempts to value the property before you do the exchange. But otherwise, the price adjustment clause should have the effect of ensuring that the fair market value of the exchanged shares is equal to the fair market value of the consideration shares, and therefore you should not have a gift portion arise. So then if we flip to slide 6, we have the last rule in section 51, and this is subsection 51.3, which, as it says on the slide, is a puck reduction rule substantially similar to subsection 85.2.1. So subsection 51.3 applies on a class-by-class basis, and it requires that the puck of a class be reduced by the amount determined by a formula. And the formula is very simple. It's the amount by which the puck of all of the shares was increased on the exchange less the fair market value, less the puck of the old shares immediately prior to the exchange, and then prorated between all of the classes of shares issued on the exchange based on the increases in the stated capital of all the classes issued on the exchange. So if, as will generally be the case in this course, we have an exchange of one class of shares for another class of shares, and there's only one class of shares issued on the exchange, then what what subsection 51.3 requires is simply that the puck of the old shares equal the puck of the new shares, and if the puck of the new shares is higher than the puck of the old shares, there's a grind. So that's all well and good. If you have the exchange of a bond, subsection 51.3 does not apply to the exchange of a bond. So you would be entitled to add to puck the amount that you would be entitled to add under the ABCA to stated capital, which generally speaking, you could go up to the fair market value of the bond. What you would have to worry about is if you had an addition to stated capital on the exchange of a bond, you would have to worry about subsection 84.1 applying to that puck addition. So if you didn't increase the net assets of the corporation by at least the amount of the puck addition, then you would potentially have a deemed dividend under subsection 84.1. So probably in all likelihood, you wouldn't want to go much higher than the face value of the bond, even if the ABCA would let you go higher. Okay, so that's section 51 and nice and easy. Does anybody have any questions about section 51, or should we go to a problem with section 51? Okay, seeing nobody, let's go to a problem. So we have problem 1 on handout number 20. And in this problem, we have individual A owning 100 preferred shares of ACO. The preferred shares of ACO are convertible into common shares and have puck and ACB of $100. In 2021, A exercises the conversion right and exchanges all of the preferred shares, which at this point have a fair market value of $130, for common shares of ACO with a fair market value of $130 and stated capital of $100. What are the tax consequences ignoring section 51? And then as a second problem, what is the effect of section 51? So if we didn't have section 51, which is a bit of an absurd hypothetical, but let's carry it through. If we didn't have section 51, then because there's been a cancellation of shares, there's a disposition as defined in subsection 248.1 on the exchange of the old preferred shares for the new common shares. And there would be no reason why this wouldn't occur on a taxable basis. Potentially you could elect under subsection 85.1, but let's assume that they're not going to do that. And so the result would probably be just that you have a taxable disposition and that you would realize a capital gain. Since you have the corporation acquiring its own shares, you would have to think about potentially whether subsection 84.3 could apply to that exchange. Although, generally speaking, subsection 84.3, there is a carve-out that would apply on a share-for-share exchange. So likely no subsection 84.3 deemed dividend, but probably a $30 capital gain on these facts, a $15 taxable capital gain, and tax payable on that $15 capital gain at the 48% rate for individuals in Alberta in 2021. Then A would have ACB of $130 in her common shares of ACO going forward under ordinary principles, because the cost of the common shares of ACO would be equal to the fair market value of the property given up to receive those shares, which was $130. So obviously you'd say, well, $30, $15 of income, tax on $15 of income at 48%, which is about $7. Who cares? Again, you multiply that number by enough shares and it becomes a big enough deal with that number. So you can sort of see that that's a dumb result, right? And that's why we have section 51. So the second part of our problem is what happens with section 51 on these facts. So if section 51 applies, then paragraph 51(1)(c) deems there to be no disposition. So the definition of disposition has been overridden by paragraph 51(1)(c). So there can be no gain, no loss, no deemed dividend, anything like that arising on the share-for-share exchange. There's only one class of shares being received on the exchange with the common shares. So paragraph 51(1)(d) will apply to deem the ACB of the new common shares to be $100, which was the ACB of the old shares. There's only $100 added to PUC on the exchange, which is mentioned in the problem. That's the stated capital of the new common shares. And so that's fine. So no issues with subsection 51(3). And the new common shares have a stated fair market value of $130. So there should be no shortfall of consideration. And so as a result, no subsection 51(2). And so the result is basically just a nothing, right? A has just got new shares and that's the end, right? So really straightforward situation, straightforward result. So then we get to the other permutations of the problem where things start to get a little bit more weird. And so in part one, we now say, okay, what if the preferred shares are debentures, so basically bonds of ACO with a principal amount and fair market value of $130? So what he'd say is, in theory, this shouldn't make a difference, right? But the bonds would have to have a conversion feature that granted A the right to force a conversion to common shares. If that was the case, then subsection 51(1) should apply. Again, you'd have no disposition, and everything else would be as it should be. However, it doesn't matter here, right? Because the bonds have a principal amount of $130, and so you would presume, if they weren't acquired in the open market, that they have an ACB of $130 as well. And so, you don't care, right? That if there's a disposition of the bond because section 51 doesn't apply, well then, who cares, right? If fair market value is equal to ACB, you have to report a disposition. Okay, fine. But there's no gain or loss. So having a deferred exchange provision hasn't actually done you any good. Similarly, on the PUC, because the fair market value of the bond is equal to its principal amount, whatever amount gets added to stated capital can't exceed $130, which is also going to be the net increase in the value of the net assets of the corporation. So subsection 84 sub 1 doesn't apply, and so you don't really need the PUC grind or anything like that in order to avoid a bad result. So that's part A. In part B, then the question is, what happens if A receives common shares of ACO and cash? on the conversion. So instead of receiving $130 of shares, A has received $110 of shares and $20 of cash. So if that happens, then very clearly Section 51 does not apply, right? It just can't, because there's been non-share consideration received. So the end, no Section 51. What you might think about is maybe Section 86 applies. And we're going to see that on like the next slide. We'll see that Section 86 might apply. But for now, we just know that Section 51 would not apply, and you'd have to figure out your tax consequences under other provisions of the Act. And then in Part C, the next permutation is what happens if the common shares have a fair market value and stated capital of $110. So we have a $20 shortfall of consideration and a $10 excessive stated capital amount. So the answer here in Part C depends on whether this shortfall of consideration is a benefit that our individual A reasonably intended to confer on a unrelated person. If that was the case, then our $20 shortfall of consideration would result in the gift portion, and would likely result in A realizing some capital gain in this case, but still only having $100 of ACB in the new shares. We also have this problem where the stated capital is $110, so we've had an increase in the puck of the shares, and so we would expect that that subsection 51(3) would apply and would grind the puck of the new shares down to $100. Then in Part D of the problem, it says, okay, well, same facts as the base case, but A is a trader or dealer in securities. And so if A is a trader or dealer in securities, then the preferred shares of ACO were probably inventory that was used in that business. And so as a result, they're not capital property, and therefore they don't meet the conditions of application for subsection 51(1). In which case you would just have, again, a taxable disposition potentially on the exchange. Now, the thing to keep in mind here is that just because a person is a trader or dealer in securities doesn't mean they can't also own securities on capital account. There's going to be some pretty strong presumption that nothing they own is capital property, but the facts could establish that the shares of ACO were capital property, especially if ACO is a private corporation. So the answer is, not all is lost, but you would have to think about the facts very carefully in this problem. And then finally, paragraph E asks, what happens if there is a conversion feature by the issuer within, in section 51? And so this is kind of not really relevant to a share for share exchange, because there doesn't need to be a conversion feature, or doesn't matter who exercises the conversion feature on a share for share exchange, as long as the shares are capital property, potentially fits into subsection 51(1). However, if it's a bond, then the wording of paragraph 51(1)(b) I think is reasonably clear that the right to convert has to be conferred on the holder of the bond and not on the issuer of the bond. So if you have a bond that you want to exchange under subsection 51(1), subsection 51(1) is only going to apply. if it's the holder's conversion right and not the issuer's conversion right. Like I said, on a share, this conversion right thing is irrelevant, and so it doesn't matter in this problem. All right, does anybody have any questions about section 51 before we move on to section 86? Okay, I'm seeing no one. We can move on to section 86. So this is slide 9 in deck 11. Section 86, like section 51, is a more or less pure share for share exchange provision. We're going to see there's a little bit of potential for impurity built in, but generally a share for share exchange provision. It's somewhat less stringent than subsection 51.1, but it does the same thing in principle, as we're going to see. So the first obvious difference in applying section 86 versus applying section 51 is that section 86 only applies to shares. There's nothing about bonds in section 86. Although like section 51, the shares have to be capital property. There are two new conditions in section 86 that we don't see in subsection 51.1. First, there is a condition that the share exchange has to occur in the course of a reorganization of capital of the corporation. Nobody knows for sure what this means. The phrase occur in the course of a reorganization of capital of the corporation is not defined. It's never been judicially considered what that means. CRA's position, which I think people just use as a rule of thumb because it's not worth fighting about, is that any series of transactions that includes an amendment to the authorized share capital of the corporation is a reorganization of the capital of the corporation. I think potentially section 86 that condition is actually broader than the CRA thinks. Again, there is no reason why you would ever fight this fight, because you would, if you didn't have a reorganization of the capital of the corporation, you would just rely on some other provision, right? You would either be in section 51 or you would elect under subsection 85.1 on the internal exchange, and you would get to the same result anyway. So it's under no circumstances would you fight about this. The other new condition is that in order for section 86 to apply to a disposition of a share, the shareholder must dispose of all of their shares of the particular class. And so this means that section 86 is basically an all or nothing provision, right? That you can have section 86 apply if you dispose of all of the shares of the class, but it does not apply if you hold back even one share of the particular class. Moving on, we have subsection 86.3 providing that subsection 86.1 does not apply if section 85 applies. Since subsection 51.1 is not mentioned in subsection 86.3, and since section 86 is mentioned in subsection 51.4, then this means that section 86 takes precedence over subsection 51.1 in circumstances where section 86 can apply. So if you have an internal share exchange where there's been you filed articles of amendment for the corporation and you're exchanging all of the shares of a class for another class, then section 86 applies and section 51 cannot apply because section 86 applies. Again, and you could make section 85.1 apply on the internal exchange, therefore causing section 86 to not apply if you file the T2057 on the internal exchange. The big difference with Section 86 versus Section 51 is that, like I said, Section 86 is not a pure share-for-share exchange provision in the way that Section 51 is a pure share-for-share exchange provision. So the shareholder on a Section 86 exchange can receive property from the corporation and still qualify for a partially tax-deferred exchange under Section 86. This does make Section 86 somewhat more flexible than Section 51, provided that you satisfy the other two requirements that are needed, namely the amendment of the share capital and the exchange of all of the shares of the class for shares of another class. So then we can flip to slide 10, and we can look at the effects of subsection 86.1. It should not be super shocking, I think, when you see the effects on the slide, what the effects would be. If you've been following along with what the effects of Section 51 and Section 85 were, then this looks like pretty much a hybrid of the two provisions, which is kind of what you would expect. So first, the first result is that the taxpayer is deemed to have cost in any non-share consideration received on the exchange equal to the fair market value of the non-share consideration. So this is exactly the same thing as would happen under subsection 85.1. Second, the taxpayer is deemed to have cost in their new shares equal to the amount, if any, by which the ACB of the old shares exceeds the ACB of the non-share consideration. Like Section 51, this ACB gets prorated between the different classes of shares received by the taxpayer based on the relative fair market value of each class of shares. So again, if there's only one class of shares received and there's no non-share consideration, then the ACB of the old shares equals the ACB of the new shares under subsection 86.1. Third, the taxpayer is deemed to have disposed of its old shares for proceeds of disposition equal to the fair market value of the non-share consideration plus the cost of the new shares. Unlike subsection 85.1, you cannot elect for higher proceeds of disposition. So section 86 will always apply to cause the maximum deferral that is allowable in the circumstances. We can then flip to slide 11. And these are subsections 86.2 and 2.1. I don't think we need to dwell on either of these provisions because they're really, really similar to other provisions that we've already talked about. And so if you understood how those provisions worked, you will understand very intuitively how these ones work. So like section 51, subsection 86.1 has an anti-avoidance rule that applies if inadequate consideration is received by a shareholder on an exchange. The only real difference versus subsection 51.2 is that you need to account for both the fair market value of the new shares and the fair market value of any non-share consideration received in determining if there's been a shortfall of consideration for the purposes of applying subsection 86.2. Aside from that, exactly the same as subsection 51.2 works in the same manner. You should give subsection 86.2 a read to make sure that you understand it, but in principle, exactly the same, just accounts for the fact that non-share consideration is also allowed. Subsection 86.2.1 provides for a puck grind in the event that an excessive amount is added to stated capital. As with subsection 85.2.1, the intention is that you should only be allowed to add puck to the puck of the new shares an amount equal to the puck of the old shares, less the fair market value of the non-share consideration. Again, would encourage you to read subsection 86 2.1 on your own. I think we have a problem and we're going to look at it a little bit. But generally speaking, again, if you understand how subsection 85 2.1 works, subsection 86 2.1 is not going to be earth-shattering for you. So with that, does anybody have any questions about section 86 before we start looking at some problems with section 86? Okay, seeing none, let's carry on. So in problem 2 of handout number 20, we have the same situation. We have an internal share exchange. The question asks, well, what happens if section 51 and section 86 didn't exist? So in this problem, B owns 100 Class B shares of BCO with pocket ACB of $1,000. As part of a restructuring, BCO issues to B 50 Class C shares and a promissory note in exchange for the Class B shares. The fair market value of the Class B shares at the time of the exchange is $1,000. The fair market value and stated capital of the Class C shares is $9,000. The principal amount of the note is $1,000. And so the question is, what are the tax consequences ignoring section 86? So again, the result would be substantially the same as our result where subsection 51(1) didn't exist. What would likely happen here is that going through these things, you would think, first of all, could subsection 84(3) apply? You'd want to think about whether, again, given that there's a share for share exchange, whether the exclusions would kick you out of subsection 84(3), or whether you're going to get stuck with a $9,000 deemed dividend, which is the fair market value of the property received less the $1,000 stated capital of the shares that were canceled. If you satisfied yourself that subsection 84(3) wouldn't apply, then the result would potentially be a capital gain if you did that, where you would have a $9,000 capital gain, which is equal to the fair market value of the consideration received less than $1,000 ACB of the property. You would also be concerned that, and perhaps subject to subsection 248(28) and the rule against double tax, and whether there might be some reduction of your proceeds to disposition, but you'd be worried that you'd also have a subsection 84(1) deemed dividend if section 86 didn't apply, because as you can see, they've added a further $9,000 to the stated capital of the Class C shares. And so very clearly, since the only thing exchanged for these shares were other shares, there could not have been an increase in the net assets of the corporation. So there's nothing to support that addition to the stated capital of the Class C shares. So the moral of the story is you're going to have at least some kind of a taxable event if neither section 51 nor section 86 applied. And the best case scenario would be that tax result would be a $9,000 capital gain. Again, that is an absurd hypothetical because section 51 and section 86 do exist, and one of them was going to catch the share exchange, probably section 86, or in the worst case scenario, you'd avoid the problem by electing under subsection 85(1). But anyway, so now we can move on to what happens when section 86 does apply. And so since section 86 does apply, or at least could apply, our individual B gets off much easier if section 86 applies. So assuming that the shares of BCO, the 100 Class B shares, are capital property, we're being told that there's a reorganization. So we can assume that that's a reorganization of the capital of the corporation, and therefore that the conditions of application of section 86 should be met because B is disposing of all of her Class B shares. The consideration for the Class B shares includes the Class C shares, and nobody has said anything about subsection 85.1. So section 86 looks good, probably applies. So applying subsection 86.1 first, B is going to be deemed to have cost in her note equal to its fair market value of $1,000. She'll be deemed to have an ACB in her new Class C shares equal to the amount by which the $1,000 ACB of the Class B shares exceeds the $1,000 ACB of the non-share consideration, which means that the Class C shares have a nil ACB going forward. Finally, B is going to be deemed to have disposed of the Class B shares for the total cost of consideration determined under subsection 86.1, which is $1,000. Since the ACB of the Class B shares was $1,000, then no gain or loss is realized here. We do still have this excessive puck addition, though, to deal with. And that means that we have to turn to subsection 86.2.1. And so we will need to grind that amount. And so this is under paragraph 86.2.1a. So the first thing we have to do is reduce our A minus B bracket, where variable A is the puck addition of $9,000. Variable B is the puck of our old shares less the fair market value of any non-share consideration. And so since the puck of the old shares was $1,000, the fair market value of the non-share consideration is $1,000. Variable B is 0. And so as a result, the A minus B bracket reduces to $9,000. So that's our puck grind amount. C over A, well, there's only one class of shares issued, so C over A is a 1/1. And so the full $9,000 of puck grind gets allocated to the Class C shares. And so the puck of the Class C shares is now 0. Okay. Is everybody okay with that base case problem? All right, seeing nobody, we can go to our permutations of the problem. And so in permutation number 1, our individual B, instead of the Class C shares, they're going to receive a promissory note with a fair market value and principal amount of $5,000, as well as Class D shares of BCO with fair market value and stated capital of $5,000. So again, since the base case scenario hasn't changed, where we have a disposition of all of our Class B shares, receiving back at least some shares of BCO, we have the stated reorganization. So section 86 applies. So conditions of application still unchanged. Applying subsection 86.1 first in this problem, because we have to, B is deemed to have cost in her note of $5,000. She's deemed to have ACB in her new Class D shares of BCO equal to the amount by which the ACB of the old shares exceeds the ACB of the non-share consideration. So 1,000 minus 5,000, which is deemed to be nil. And so the result is that there's ACB in the new Class D shares of nil. B is now also deemed to have disposed of the Class B shares for the total cost of consideration determined under subsection 86.1, which is $5,000. Since B's ACB in the Class B shares with $1,000, this means that B realizes a $4,000 capital gain. However, this $4,000 capital gain is probably going to be recharacterized as a deemed dividend under subsection 84.3, and paragraph J of the definition of proceeds of disposition will therefore kick in, and it will grind the amount of the proceeds of disposition. down to nil in this case. And so there's going to be a deemed dividend instead of a capital gain of $4,000. Then we have to deal with this excessive puck addition on the Class D shares because we've added $5,000 to the stated capital of the Class D shares. And this means that we have to consider subsection 86.2.1. The corporate law addition was $5,000. And so again, we turn to 86.2.1a. Our variable A amount in the A minus B brackets is the addition of $5,000. Variable B is the puck of the old shares less the fair market value of any non-share consideration. So variable B is 0, since the puck of our old shares of $1,000 is less than our non-share consideration of $5,000. So the A minus B bracket reduces to $5,000. Again, C over A, since there's only one class of shares, is 1 over 1. So we have a $5,000 puck grind allocated solely to the Class D shares, and so the puck gets ground to 0. So that is permutation B. Sorry, permutation A rather. Then in permutation B, there's a question that the question asks, what happens if B receives a promissory note with a fair market value and principal amount of $500, as well as Class E shares of BCO with a fair market value and stated capital of $500. So there's only $1,000 of total consideration for shares that had a stated fair market value at the time of the exchange of $10,000. So this is, again, theoretically permissible. Subsection 86.1 itself does not require adequate consideration, and subsection 86.2.1 would not be fussed about this transaction because the total puck addition plus the total non-share consideration is only $1,000, which was the puck of the old shares. So you don't have anything happening there. But your potential issue here is the application of subsection 86.2. And again, we don't have enough facts to know this, but if the gap between the $1,000 of consideration taken back and the $10,000 fair market value of the Class B shares is reasonably regarded as a benefit that B wanted to confer on a related person, then subsection 86.2 would apply. And if that was the case, then B would be deemed to have disposed of the old shares for an amount equal to the lesser of the cost of the boot of $5,000 plus the gift portion, which is $9,500, or the fair market value of the old shares, which was $10,000. So there would be a $9,500 of proceeds of disposition, $1,000 of ACB, and so the result would be that individual B would realize an $8,500 capital gain. And there's no adjustment to the ACB of the new shares as a result of this $8,500 capital gain. And presumably nobody gets to, on the gift portion side, the person who received the gift portion effectively doesn't have any ACB addition to their shares either. So what this means is that there's going to be double tax at some point in the future when the related person disposes of their other shares of BCO. And then finally, paragraph C in problem 2 asks, what is the meaning of the phrase in the reorganization of the capital of the corporation used in subsection 86.1? And so, like we talked about, that is not a defined term. It's not a judicially defined term. Administratively, the CRA has given it a meaning. And for the most part, everybody just rolls with that administrative meaning. What the CRA has said is that in the course of reorganization of the capital of the corporation just means any transaction in a series of transactions in which there was an amendment to the authorized share capital of the corporation. So that's section 86. Does anybody have any questions about section 86? Okay, seeing none, I'm going to stop recording. Let's take